Things are not that easy to predict. Okay, so 29 and a 30 year doesn't make any difference. But in the market, the new 30-year bonds have slightly lower yields compared to 29 and a half. And long-term capital management says, oh, we can make money off of that. Okay. Yeah, it's simple. Financial engineering wise, I don't have a lot of money. I mean, normally, if I'm investing only my own money, let's say I'm managing $3 trillion, 3 basis points is not serious amount of money, even with $1 trillion. But I can borrow money, right? Here's how I'm going to do as a trade. I'm going to buy $100 billion worth of 29 and a half year old bonds. Okay. I'm going to put that into the repo market, which is basically an overnight collateralized loan. And basically, I'm going to short the 30-year bond using that. That's all there is to it. You keep making that difference. The trouble is, why is there such a difference? Turns out some people, 30-year bonds tend to be more liquid. Why? Because a lot of long-term bonds are bought by places like pension funds. Even though we don't do a good job, let's say I am KTRS, Kentucky Teachers Retirement System. I was smart enough back in 2005. I looked at their books, and there was no hint of trouble in the news at the time. There's no way I'm putting my money in there. It's a defined benefit plan, so in that sense, it's nice. I said, we had the option to put it into our version of 401k. So that's what I did. As a Kentucky Teachers Retirement System, I make commitments to my people. For example, if I was on that system, after having served for 27 years here, I'm on my 20, but some people have done it. Based on your highest 5 salaries, they give you a fixed pension that is also indexed to inflation and stuff. Plus, you get the Medicare gap as well. So Medicare plus whatever they give you, you have no health expenses either, right? That means that system made commitments to you. And they made that commitment, would have made that commitment to me 20 years or 30 years before I retired. So they can estimate what sort of commitments they're going to make. I am giving them money, so they need to invest that. Well, what they do, they invest into long-term bonds. So as soon as a new bond is issued, they go buy that, especially the older ones. So there aren't that many older bonds that are trading in the market compared to the new one. There's a difference in the liquidity. That's kind of driving, right? In fact, that's the primary reason why 20-year rates are lower than 30-year rates, even with all that perfect ability to forecast. Yeah. And the same thing happens even in so-called inflation index markets. We talked about nominal versus inflation. In fact, if I'm a pension fund, I probably would be more interested in inflation index funds because my obligations are also indexed to inflation. Every year, those pensions in the KTRS people or KERS people, they have to be indexed to inflation. Tools are there, so no problem. Again, it's not even an inflation risk issue because inflation is completely compensated with inflation index bonds. The 20-year rates are slightly higher than the 30-year rates. Why? Again, liquidity. Liquidity is important. If people are trading these things, the bid offer spreads are a little bit higher when they're not that liquid, which means people demand a premium for that. And that's what that 4 basis points is. And as I said, with the fixed income stuff, that 4 basis points can make people a lot of money as long as it stays stable. No, we'll talk about that immersion. This is about liquidity. Those kind of immersion on the long term, it has nothing to do with recession fears or anything like that. I'm going to come to that on the short end. That's all about liquidity. Okay? There's a third theory. Again, it's somewhat a descriptive theory. It's called the preferred habitat theory. Certain investors want to operate in certain maturities. Again, if you're talking about pension funds, typically the horizon of pension funds are anywhere from 20 to 30 years. So they're more likely to operate there. On the other hand, uh, companies like insurance companies, banks, they like operating in shorter end. So, in a sense, according to that theory, those two ends of the maturity spectrum kind of move a little bit independently. They cannot move too independently, but there's kind of a movement. Coming back to, um, let's look at here, the shorter end. Currently, the 3 month rate is 434, okay? And 10-year rate is actually 429. Let's actually do a graph of that until 10 years. Let me get these numbers. These graphs give you a better way. This is actually 4 weeks, so I'm going to do this for 52. I'm going to ignore these. You guys know how to make a two-sided graph? Grab your data, insert, find these little charts, find the one that has little dots. Come on. Apparently, I have not picked it the right way. What the hell is going on here? I think Excel thinks of these as text. Let's see. Since I copy pasted them, there's a function called value. If you have a text, hey, yeah, let's see it. Okay. I don't like having it on the same sheet. Right click on the graph, Come on, man. Move charts to a new sheet. All right. This is actually, you don't see this kind of yield curve that often. Historically speaking, yield curves tend to be upward sloping, but at least until about 3 years, it's downward sloping. And you could also do certain things with the axes. Right click. I like details in charts. Format axis. I want 1 year between units. So current very short term 4-week rates are 437.